Hello, everybody, and welcome once again to the Master of Money program. I'm Steve Beeman, your host, and I want to thank you for joining us each and every Tuesday here on Ustream. Whether you're joining us live in our Oak Brook studios at the beautiful facilities of Harvest Investment Services, or you're with us live in the audience on Ustream, we're glad that you share this time with us. We endeavor each and every week to bring you better and better content that can help you begin a better path to prosperity. Last week when you joined us, we talked about packaged products. We talked about mutual funds, unit investment trusts, and that newer derivative called an exchange-traded fund. These are tools that you can have in your toolbox that help you not just sustain your wealth, but also can be very well used to build your wealth. And we hope you found that interesting. We always ask, if you have the chance, if you have questions, you can write us at questions@societytoadvancefinancialeducation.org. And in fact, as you may recall last week, we changed that to simplify it. So you can write it at questions@safefinancial.org as well. We want to thank you once again for being with us. Now, each and every week, we try to answer a question from the audience. And last week, we got a very interesting question that oftentimes comes up. In fact, I dealt with this throughout my career in financial services, and that is this issue of what is meant when an investment professional uses the word beta. Well, simply, it's a Greek word that's used in the markets to define risk. Well, that brings up a pretty big question for you and me, and that is, how do you define risk? Well, as I've gone through my life, I think of risk as the risk of encountering the unknown. In finance, that could be the risk of losing money. None of us likes to do that. Well, in the institutional investment world, risk is often defined not by whether something goes up or down, but by the volatility with which it does that. So beta has become, for the institutions, the measure of volatility. In other words, a stock can go up, but if it does so with a lot of what's referred to as standard deviation, that will have a high beta, and the institutions don't like that. Now, you may ask yourself, why? Why is the variability of a stock price or an investment price so critical to the institutions? And that's because they leverage. The more leverage you put behind an investment, the more stable you want those returns to be. So when you hear your investment professional talk about the beta of an investment, all they're referring to is the volatility of that investment relative to the market itself. The market is measured as a beta of 1. So if your stock or investment has a beta higher than 1, you know that it's more variable than the underlying market. If it's less than 1, you know it's more stable. Now, if you've joined us for several weeks, a couple of weeks ago we talked about gold. Well, gold has a very low beta. It's very uncorrelated to the market, and it's very stable. So you've got an asset class there that you can use to hedge other positions. And how to hedge a position we're going to get in future sessions of the Master of Money. So we welcome you to keep those questions coming. Remember, it's questions@safefinancial.org. We are so very pleased once again you've joined us tonight. We have a very interesting program. We're going to be talking about perhaps the oldest investment there is next to gold, and that's real estate. It's been an interesting topic of discussion for me many times in my career, as most folks, first of all, are active investors in real estate through their own homes. But often they don't include those homes in their own portfolios, which they should. So whether you think about it or not, many of you have an allocation of your overall assets into real estate. So we want to talk with you tonight about how real estate can be used to both preserve your wealth, to build wealth, to generate income, and actually to generate some pretty handsome tax advantages too. So we look forward to that discussion. But each and every week we begin our program talking about the geopolitical world and what's going on in the more macro side of the markets. And this last week, many weeks in the past, I've talked about the Russian President Vladimir Putin. Well, this last week he was in Valdai and gave a very interesting policy speech in which he blamed the United States' behavior in the last 10 years as coming out of the Cold War as a victor. He used words that were very threatening, very disconcerting, and when you take that in consideration of the bomber flights that have hit NATO airspace and American airspace, and recent submarine incursions into the northern Baltic states, it makes us want to keep a close eye on what President Putin is thinking. Now, in addition to that, as we continue to look at the globe, we've seen the globe continuing in a decline in economic growth. This is being driven by Germany and then by China, but the globe does seem to be slowing down as the economy goes forward, very contrary to what we're seeing here in the United States. Now, the importance of that is, of course, with the interlaced economies we now have, the United States could become hampered by a global slowdown. We haven't seen the effects of that yet, but stay tuned to the Master of Money, and we'll make sure you are well ahead of the curve on that. Now, the U.S. recovery, as we look to the United States, continues. In fact, when you look at the second quarter GDP numbers, we're so happy to see such growth. We haven't seen that in about 9 years. Now, you and I sit back and wonder what the third quarter will bring to light. We've now seen the Federal Reserve come out and end its quantitative easing program, meaning they'll no longer be buying government bonds. Well, what that will mean ultimately is the interest rates paid by government bonds, well, they're going to have to find normalcy sometime, and they'll be priced more on market mechanisms than Fed stimulus. Well, now the Fed has continued with their commentary while they're ending the quantitative easing programs. They're also going to continue what they call their ZIRP policy. Now, that's a cute little acronym for zero interest rate policy. Now, they're doing that, of course, to keep the United States economy from slowing down. We'll see how effective that is when third quarter numbers come out. Now, a leading indicator can be looked at as the confidence index, and we did see American confidence rise from an index measure of 86 to up around 87, which is a pretty nice jump in that index. So it looks like you and I are getting a little more confident about this economy as time goes. Now, certainly one of the confidence drivers is gas prices. And if you joined us last week, you heard me explain what's been causing that. It's nice to know that the United States is now the #1 producer of fossil fuels in the world. In fact, we produce about 85% of our own gasoline, so we are in most ways self-sufficient. That additional supply has caused prices to come down, and that itself is a boom to the U.S. economy. We think that will likely continue. As we look specifically into the markets, we did see the markets continue a little bit of a rebound last week, although they were very choppy, as we've talked about in recent weeks. The uncertainty of global markets, the uncertainty in the Middle East, the uncertainty of the Fed's moves, all of which are creating instability in the markets. Now, that doesn't mean it's bad. It just means a trend hasn't established. So we urge you to continue to look at your portfolios. Make sure that you have risk management in place so that if the market does drop precipitously, you're not caught in a bad end of that. And finally, in the markets, although it's slightly unrelated, I live here in Chicago and we produce the Master of Money in Oak Brook. And over the last weekend, we had a wonderful high wire example of daring from Nick Wallenda. The famous high wire walker crossed two of our most famous buildings on a Sunday evening walk. And it just reminded all of us that if you put your mind to something, well, you really can accomplish it. We're glad that he made it safely, and we're glad that all of the folks downtown got to witness such a wonderful event. Well, as I said earlier tonight, we're going to be discussing real estate. This is a broadly applied investment strategy by many people, whether you're a landlord or you just own your own home. We've seen it create great wealth in the past, and we've seen it create great bust in the past. Well, we're going to talk when we come back tonight about how you can be on the right side of that equation. So stay with us, stay tuned, and when we come back, we'll begin the Master of Money Real Estate Program.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice, with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors, because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Hello everyone, and welcome back to the Master of Money program. It's a pleasure to have you join us each Tuesday evening here on Ustream. It's wonderful that we can share this time to help you develop a better path to prosperity. Now, it is election night, whether you're in Maine or California here in the United States, so we want to make sure you've taken the time today to go out and vote for your favorite candidate, whichever that might be. Now, tonight, as we said, we're going to talk about real estate. Next to gold, this is probably the oldest investment that's ever been created. Going back as far as we can remember, real estate has been used as both a currency as well as just a pure investment for those in the know. Now, as you develop your portfolio, we hope you'll take another look at some of the ideas we can now bring you. There are a lot of ways to think about real estate. It can be someone's dream. I mean, here in America, it certainly was the American dream to own your own home. But it can also be, as I said, a currency and a pure investment. And we know that with the power of real estate, it's created a great deal of wealth for many, many people. But as we saw in 2008 and 2009, it also wreaked havoc on millions of people. So is real estate good or bad? Well, we're going to discuss both sides of that equation tonight. But I do want to bring you one bit of information related to the 2008 and 2009 debacle. It was 1929 that you could leverage stocks 10 to 1, meaning that if you wanted to go out and buy 100 shares of IBM, well, you only needed to put up 10% of the purchase price. Clearly, that was part of what led to the crash of 1929. Well, if you think about it, by 2008, you only had to put up 10% to buy the value of a house. That 90% leverage is part of what created the problem. Now, clearly, real estate can be thought of as more sound than stocks, but it shows you the definite problems of leverage. Now, there are a lot of ways to invest and to make money in real estate. Clearly, you have your own home. And as you have your home, you can buy other homes and rent them out. We'll talk to you in just a minute about ways to do that. But you can also buy multifamily homes. As we grow with a generation that's getting older in our country, many younger couples are opting to live in apartments and townhomes rather than single-family homes. Maybe the day of the McMansion is something that's gone by. But in addition, you can always do commercial applications, whether it's through an office building or a multi-unit industrial park. A lot of different things. You can buy land. It seems like the options never end. But if you want to do that, what kind of information do you need to make sure that you make the money you want to make? Well, there are two reasons to invest in real estate. In fact, I'm going to say two reasons plus a bonus. Reason number one is you, of course, buy real estate for the capital appreciation it brings you. It is true that over time, scarce resources tend to become more valuable. Well, I think it was Will Rogers who said, buy land, they ain't making it anymore. There is nothing more scarce than land. And as more and more population joins our shores as well as the globe, the value of land does tend to go up. So capital appreciation of properly selected buildings, houses, apartments, Yes, indeed, you can look forward to that. And I'm going to give you in just a minute some specific data on how much capital appreciation you can expect. But the second thing to look forward to is income. It's often been held by the wealthy that being a landlord is a way to make money. Now, if you go back to the Middle Ages, in order to be a landlord, you were appointed a title by the king. Well, in the free markets of the 21st century, you don't need to have a king appoint you as a landowner. You can simply go out and buy an investment property that's a rental property. And there are a couple of ways to do that. We're going to touch on those too. But as you look for capital appreciation and income, there is a third benefit to real estate that, well, the insiders know this one well, and that's called a tax advantage. And we're not about accounting here at the Master of Money program, but I'm going to go into just a little bit of it right now. In real estate, there's something called depreciation. And what that means is as you own a building, you can depreciate the value of that building over a fixed number of periods or years. Well, that depreciation costs you nothing in cash, but guess what? You get to write it off your taxes. That's a very nice tax advantage to real estate. So in addition to capital appreciation and income, you get a real nice tax gain. And that's what motivates people to do it. But the question is, do you really make money in real estate? And the answer is yes. I'm going to show you some charts here going way back to the 1930s that show average returns from real estate compared to other indexes. This first chart that's showing on your screen right now shows that since 1930, real estate has averaged about a 4% annual return. Now that's total return, including capital appreciation plus income. If you compare it then to bonds and stocks, you'll see that it doesn't perform quite as well. Bonds average about 5%, and over that period, stock in America's companies has averaged more like 9%. So clearly, there's less risk but less return to real estate. And as you look out, you should be aware that the returns may be higher in other assets. In fact, if we look at it compared to inflation, which is the real benchmark for money, in fact, let me digress a little moment and tell you something that I hear frequently. When people take money and put it in treasury bills today, paying virtually zero interest, they're actually losing money. And the reason for that is that their dollar depreciates every year by between 2 and 3%. So if the return on your money is less than 2 or 3%, your standard of living is actually depleting year after year after year. So we want to look at our investments relative to inflation. If we look at our real estate compared to inflation, we see that it does indeed outperform inflation. And it does so with a very low, here we go, standard deviation. So yes, the beta of real estate compared to the market is a negative correlation. When stocks go up, real estate tends not to do so well. But when stocks go down, real estate tends to hold its own very well. If you were around during the 1970s, you saw millionaires made with the hyperinflation that we experienced in real estate. So if you're expecting in your own portfolio going forward in your crystal ball that we're going to experience inflation, well, it may be a time that you want to consider some real estate. Again, if we look at it compared to inflation, real estate has outperformed inflation by about 1% a year since the 1930s, where stocks have outperformed by around 6%. But again, I want to caution you as you look for investment returns to realize if we go to the 1970s, a period of very high inflation, well, in fact, real estate outperformed stocks by about 2% a year. That's not a bad deal. So within the context of your portfolio, you might consider talking to your advisor about broadening out your horizons so that you have some uncorrelated assets in there. And real estate may just fit the bill. Now, you can buy properties directly if you want to play this game. I know a lot of people who buy single-family homes and they rent them out. And in fact, just today I attended a seminar from a company that will teach you, now, not for free, but they'll teach you how to go out and flip homes. You buy them, fix them up, and resell them. That's a highly successful game if you're good at it, but it takes an awful lot of work. And most of the folks I talk to don't really want to use real estate like that. Yes, it's a high return, but there's an awful lot of work behind it. Well, there are several other ways that you can get the capital appreciation, you can get the income and the tax benefit without directly owning properties yourselves. One of the longest and tried and true ways to do it is through a limited partnership. Now, limited partnerships exist all over the place, and there are a number of very good ones that pool together investor money and use that money to go buy medical office buildings, for example. They have long-term tenants, they get good depreciation on the building, so you tend to generate a very good return. Now, these partnerships are very strong investments for people, but they have some downside. Let's take a look first and foremost that in most investment partnerships, there's a lockdown on your money. You can't get it back for so many years. So when it comes to liquidity, and we've talked about that in other Master of Money programs, liquidity in the limited partnership world can be somewhat low. So you want to be careful. So the question is, if you want to invest in real estate and you want to do it because of the inflation hedge of it, because of the gains, the tax benefits, is there a way to do it where you don't have to go out and manage the properties directly? You don't have to lock your money up in a limited partnership, but you want those benefits. Can you do it? Well, if you follow the Master of Money, it was just last week we talked about something called an exchange-traded fund. And you bet you can buy mutual funds and exchange-traded funds that will take care of that problem for you. Companies like Cohen & Steers Real Estate put out partnerships, but they also have mutual fund offerings and exchange-traded fund offerings where you can participate in their real estate markets without the liquidity problem of the limited partnership and without the direct work of doing the work yourself. So we urge you to look into some of these different mutual funds and exchange-traded funds as you consider what's right for your portfolio. I wanted to give you just a few as we look to this. There are 4 that I wrote the ticker symbol for that you might want to explore. Now, whether these are appropriate for you, there's no way for me to know. You want to talk with your advisor about it and clearly do your own due diligence. But here are some ideas for you. VNQ, that's an ETF that trades in real estate. SCHH, that happens to be Charles Schwab's real estate offering. Or FRI or ICF. Those are symbols of real estate offerings within the ETF world. Now, related to this, people ask frequently, what's a real estate investment trust or a REIT? Well, that typically is a mutual fund that invests in real estate, and there are REITs that invest in global real estate, domestic real estate, commercial real estate, residential real estate. You can pick your flavor however you want to do it. So there's a lot of opportunity here, a lot of options for you to invest in real estate. But you have to look at it in the broad context of your entire portfolio to make sure that you don't get too heavily weighted in it. As we saw from the charts earlier, real estate's not going to greatly increase your wealth. It will help protect it. It will give you some benefit, but it's not going to be as strong over long periods of time as stocks, for example. Well, you want to keep that in consideration. And as I said early on in the program, as you look at your portfolio, please don't make the mistake I've seen so many people do. Make sure that you include your own house's value in your portfolio. That is ultimately an investment for you, and to not consider that in your portfolio will typically lead to a misallocation of assets. We don't want to see you do that in your financial plan. So be aware of that and make a special note of it. So tonight, we're talking about real estate, a very old idea. Now, one of the things that you'll notice that you want to be sensitive to as well, it used to be that you could buy real estate when you bought it, you owned it. Well, something else to consider now, you want to look at property taxes. Around the United States, we're seeing local and state governments fiddle around with property taxes as they look to fix state budgets. Well, you want to make sure if you're buying into a direct real estate investment, a real estate investment trust, a partnership, or an ETF, that they're not buying properties that are going to be really hammered if those local governments come out with the firing squad on property taxes. Be aware of it. It's a real potential lightning rod that's out there. Now, as always, we welcome you to ask us questions by writing questions at safefinancial.org. We're available to you 24 hours a day, 7 days a week. And we welcome you, as always, to visit safefinancial.org on the web, and also to visit us on Facebook, where we have a page, or even become a fan on Twitter. We have a lot of stuff up there. We have published, as I've indicated in different programs, over 400 articles. All of those articles are available to you if you'd like to learn them. So we welcome you to contact us and to stay with us at the Society. We also want you to know that next week, when we come back, we're going to be talking about momentum strategies. For those of you who have 401ks, IRAs, 529 college plans, or other investment ideas, we want to make sure that you're familiar with this often used institutional strategy of momentum. How is it played? How can you participate in it? And how can you use it to expand your wealth? So make sure next week you join us. And as I said, we are sponsored by the Society to Advance Financial Education, a not-for-profit organization dedicated to helping America build a more prosperous path. If you're able to support the Society, we would ask that you click on that GoFundMe button. And if you're comfortable with a donation of $5, $10, $100, whatever works for you, we would ask for your support. We want to thank our primary sponsors, Ron Blake from Ron Blake Music, who allows us to use his beautiful music at the beginning of the program. We want to thank Harvest Investment Services, who allows us to use these beautiful facilities. Also, some of our other sponsors, Superstock Investor, a company helping retail investors find a non-stop stream of good stock ideas. And also Chris Yance, who's helped write some of the music we use in our later in the show. All of these people support the Society because, well, we know that it's all about you, and we want to be there for you each and every day. So join us next Tuesday as we come together once again to talk about investing in momentum strategies. And thank you for joining us tonight. And don't forget to get out there and vote. So join us once again next week for another Master of Money.